Do you think the macros for Indian markets, they have bottomed out, or GDP for FY14 could be still below 5%?
My view is that I don't think data is looking as if it's going to improve. If anything, there is still bias on the downside. Because if you think about it, agriculture is not going anywhere. Manufacturing, big trouble. Services was the only horse that we've been riding on, in the last several quarters. Now, that's financial services, that's telecoms and stuff like that. Now tell me, do you really think there's a bull market in telecom ahead of us or behind us? Or there's a bull market in financial services ahead of us or behind us? I mean, it doesn't take a rocket scientist to figure that out. So where on earth are we going to get 5% or 6% from if the major components are, not looking good? And if you take it on the other side, that, whether personal consumption expenditure, you take net exports, or you take, the fixed capital formation part of it. I don't see personal consumption was the one that was driving GDP growth. Okay. But do you really believe that faced with an uncertain job market, uncertain labor market, Indians would be having greater propensity to consume or reduced propensity to consume? So those are the questions we need to answer. My view is that it would be a hunkering down year for the consumer rather than a splurging out year. And auto sales are a good barometer. They are telling you that there is reasonable amount of stress on the consumption side. I met somebody from Hindustan Levers the other day. He was saying that we are seeing a lot of stress, a lot of headwinds on the growth front. So, it is, you can put it all together that which component of GDP growth is going to deliver. And I don't see, I wish I could say that, but whether we're going to go to 6.5% looks very tough.
What about absolute valuations? What's your take on the total, on aggregate basis, how do valuations stack up for Indian markets?
I never look at valuation, so I don't even know what multiples most stocks are trading at. I don't profess to be value, I profess to be momentum. The momentum is positive, I'm long. The momentum is negative, I'm short. So, because valuation is all rubbish. Something 6 times earnings today, we say it's cheap, but how do you know it's not going to go to 60 times earnings? Not because the price will go up, but because the earnings will come down. So there are 2 ways multiples can expand.
Yes.
And in a bear market, in the kind of economic situation I foresee, it's more likely they'll go to 60 multiple. But that's because 10 rupee EPS will become 1 rupee EPS. And hey, guess what? You were right on the multiple expansion, but in the wrong way. So that could happen.
I've been told that you are extremely negative or bearish on banks.
Yes.
Why is that?
Our view changed sometime in January when we realized that the market internal spreads, etc., were looking very terrible, and therefore which sector could cause the most damage. And again, it was a classic, in my view, a classic that if you think about it, banks were the only sector that was running up. SBI was 2600 and HDFC Bank was 670, ICICI Bank was 1180, Axis was I think 1450, 1500, thereabouts. And everything else around it is hurting. Exactly like what happened in 2000, when IT was the only pack that was running. And we expected the service provider, 2 other companies, to make record profits while the customer is going to be hurting so much. It's like I am a broker and my mutual fund customers are going to get outflows. And somebody buys my stock thinking that you're going to have earnings growth for the next 25 years. That's absolute nonsense. We can see that if my customer is hurting, how can I make money? The 2000 ended very badly. Okay. Here the banks became the technology stocks of 2000. Okay, everybody piled into them. They're over-owned like crazy. Everybody and an uncle has got just banking stocks. It's a classic that you have a declining economic growth scenario ahead. Consumer is not going to consume so much, so where do you give loans out to consumers? And obviously companies you don't even want to touch by way of loans. So where is the credit growth going to come from? In fact, your efforts are going to be on recovery rather than giving out fresh loans. In that situation, can you really, and by the way, and the other metric that we really looked at was that each time a market's earnings growth or absolute earnings starts to come predominantly from the finance sector, you should become very, very cautious. If you look at from 2005 to today, the contribution of banking and financial services to the Nifty earnings has gone up like 3 times.
So the weightage is nearly 40% now.
It is nearly 40%. S&P 500 in 2007 was like, I think about 40% of S&P's profits were coming from the finance sector. This year, 60% in FY13, 60%, 50 or 60% of the Nifty earnings growth is going to come from banks. Next year, between 30 and 40%. Each time that happens in history, you go back in history, analyze markets, when finance sector, which in my view is a sector of smoke and mirrors, that starts to contribute to a market's earnings, you have a serious problem. So we are looking at just 4 banks delivering almost more than half of the Sensex's growth or the Nifty's growth this year. in this situation, does it take a rocket scientist to figure out that these numbers are unrealistic? These companies cannot grow 25-30%. There will be room for disappointment on earnings on all the banks, the major banks. And then it's over-owned. That's the other thing. So I look at that very, very closely. It doesn't take too much to put it together.
So by that logic, are you more bearish on private banks? Because they are extremely overowned.
Yeah, they are completely overowned, because in the sense that, they are, there is no promoter holding per se. It's almost all free float, right? And you're talking about $120 billion of combined market cap for the big three. And the other thing, remember, there's another aspect to the reason why we turned bearish on banks was that, the banking licenses are due, and I'm hearing that October, November, you'll start to get the first, and over the next 12 months, 15 months time, you start to get more banking licenses in. This is exactly what happened in 2007 with telecom, and we turned bearish on telecom. Apart from all the other angles of over-ownership and all the valuation metrics looking completely, off the charts, the other thing was that you're going to get significant new competition. There's a cozy cartel of 3 or 4 GSM providers who had basically gathered all the spectrum, with keeping rates reasonably high by at least historical standards. And when the new guys came in, what happened to the sector. Telecom of 2007 is banking of 2013. You have a group of 3 or 4 it's a cozy cartel between the 3-4, big 3-4 banks. They keep rates reasonably high. They make reasonably high returns on equity, reasonably high NIMs. New competition coming in, it's again a no-brainer. So everything else apart, just the mere fact that, you have more competition coming in my view, is it at least forces you to reconsider review. So we reconsidered. We are bearish now.
So what is the trade for FY14? Go short or buy this market, but buy this market on every decline, because eventually markets will bounce back?
I don't think this market is going to bounce back in a hurry. We'll have bear market rallies, and we'll see good ones also. 5% in a week. I mean, those kind of things have happened in the past. Even 2008 was not a straight line down. You remember, there were rallies which almost convinced us that the bull market was back. We will have something of that sort, but the trade for this year is to be net short if you are able to short, or to stay out of equities if you are able to be out of equities.
Do you see a possibility, or would you assign a strong degree of probability to the fact that in this financial year the Nifty could easily crack below 5,000?
I wouldn't be surprised at all.
Roughly 15.5, 16,000 on the Sensex.
Yeah, I mean, 2,000 points from here is not a whole lot, because I do believe firmly that the worst of the global equity bear market is ahead of us. EM started the bear market, a couple of months back, but developed markets haven't, and they will get there. So when that happens, you can imagine what happens to the already weak EMs.
The bulls would argue that in next 2 or 3 years...
Are there any left?
Some of them. Okay. Some of them. Hard to find one. 3 months ago, they were only bulls.
3 months back, you told me you can't find a bear except in Baikala Zoo. Now you're telling me you can't find a bull. If I were to take that as a contrary indication, we should be out there buying, right?
Is that what you're doing?
No, not at all.